Okay, let's dive right into this explainer. Today, we're going to follow the fascinating and honestly kind of hidden journey of a single dollar. We're tracking it from the exact moment a deal gets signed all the way down to the taxman's cut. It's a journey governed by some pretty strict accounting standards, specifically ASPE 3400, and it's full of judgment calls and definitely a few surprises along the way. Now, here's a harsh reality to kick things off. Just because you've collected a check doesn't mean you can instantly claim it as revenue. It's a huge misconception, right? You might literally have $1 million sitting right there on your desk, but to an accountant, that money is practically a ghost until you've actually earned the right to claim it. So, to demystify all these rules, we're going to navigate 5 crucial stages today. We'll start with the absolute bedrock rules of revenue. Then we'll tackle complex long-term projects, untangle those messy bundled contracts, figure out who the true seller really is, and finally, cross the bridge from accounting income into corporate taxes. All right, moving into section 1. When is it actually revenue? This is where we establish the absolute bedrock rules of revenue recognition under ASPE 3400. Before we start tracking our dollar, we actually need to define what revenue is in the first place. Simply put, it's an inflow of cash from your day-to-day business activities. But here's the kicker. It's always net of things like discounts, returns, and sales tax. Think about it. If you collect sales tax on behalf of the government, well, that was never your revenue to begin with. You're really just holding on to it for them. So to officially call that dollar revenue, you have to check some pretty major boxes. We can think of these as the risk, reward, and reliability anchors. For instance, have you actually transferred the risk to the buyer? If the product breaks in transit, whose problem is it? Are you reasonably sure you'll actually get paid? And of course, has the product actually been delivered? Until you can confidently say yes to all of these, well, that dollar stays in limbo. Let's jump to section 2, the percentage of completion method. Because, as we know, not every business transaction is as simple as just buying a coffee at a cafe. Imagine for a second you're building a massive bridge, and it's a 3-year project. You obviously can't just wait until year 3 to recognize all that revenue. If you did, your business would look completely dormant on paper, literally bleeding money on supplies and labor for 2 straight years. That simply isn't an accurate reflection of economic reality. To fix that, we use the percentage of completion method. Let's look at a scenario where a contractor spends just over $2,000 in year 1 out of an estimated total of roughly $8,000. By dividing those costs incurred by the total estimated costs, we get 26%. What that means is they can logically recognize 26% of the contract's revenue right there in year 1. It brilliantly ties the money directly to the physical effort they've expended so far. All right, leveling up the difficulty, section 3, navigating multiple element arrangements. This happens all the time in tech, consulting, you name it. When a contract bundles a bunch of things together, say software, training, and ongoing support, all for one lump sum, ASPE 3400 basically forces you to ask a really simple question. Do these items have value on their own? Like, could the customer go out and buy them separately? If the answer is yes, you actually have to break that single contract apart into distinct pieces before you can even think about recognizing the revenue. For example, take an HR firm selling a massive $1.2 million service bundle. They can't just claim all that cash at once. No way. They have to use what's called the relative standalone selling price method. Basically, they have to estimate what each individual service, like payroll versus training, would sell for completely on its own. Then they figure out the relative value of each piece and slice up that total price accordingly. It's meticulous, sure, but it ensures the revenue perfectly matches the exact service being delivered. Moving right along to section 4, principal or agent. This is a bit of an identity crisis that drastically changes what the top line of your income statement looks like. Let's look at a hypothetical matchmaker ad agency to solve this. Matchmaker basically helps clients find ad space in newspapers. The client pays Matchmaker 115% of the standard rate. Matchmaker then pays the newspaper 100%, and they keep 15% as their matchmaking fee. So here's the million-dollar question. Does Matchmaker report that full 115% as gross revenue, or just their 15% cut? To figure this out, Matchmaker has to seriously weigh their risks. If you hold general inventory risk and you have the latitude to set the prices, you might be the principal and you'd report gross revenue. But in our story, if an ad prints terribly, who's actually on the hook to fix it? It's the newspaper, right? The newspaper holds the primary obligation. Because of that, Matchmaker is merely acting as an agent, so they can only report their 15% fee as true revenue. And finally, we reach the climax of our dollars journey in Section 5, from accounting to taxable income.
Now, here is the big twist. The government doesn't just look at the neat little net income your accountants calculated and send you a bill. Nope. Tax law is a completely different beast. It's designed to incentivize behaviors and enforce public policy. You actually have to start with your accounting income and then run it through a strict 4-step gauntlet of specific additions and deductions just to find the actual number the government wants to tax.
To put that into perspective, say your accountant rightfully expensed 100% of the meals you bought for clients. Well, tax law says you can only deduct 50%. So actually, scratch that initial calculation. You have to add that other half back, which increases your taxable income. And what if your company got a parking ticket? It's an accounting expense for sure, but the government absolutely isn't going to let you use a penalty to lower your tax bill, so you add that back too. Conversely, you do get to subtract things like capital cost allowance, which is basically an accelerated depreciation designed to encourage business investment. So we've traced the dollar from a strict, principles-based assessment of when it's earned, all the way over to a policy-driven tax calculation. Accounting income shows you the economic reality of your business. Taxable income, on the other hand, shows you your legal obligation to society. But I want to leave you with this provocative thought. Between these two vastly different rulebooks, which one do you think truly reflects the actual health of your business? Understanding the gap between them, well, that's the true hallmark of financial literacy.